Today, we're going to take a look at the stock index hedge strategy, which you can trade on any stock index like the DAX, the Dow, the S&P or the NASDAQ. We're going to look at the stock index Hedge EA and how it can automate the strategy for you. Okay, so let's look at the strategy in a little bit more detail. So the reason I came up with the stock index hedging strategy was partly born by the opening range breakout strategy. So if you're familiar with some of my products and the way that I trade in the live rooms, you'll know that I've got the opening range breakout EA, and this automates the opening range movements on the stock indexes every day. So every day, the break happens at either 8 o'clock in the morning or 2:30 in the afternoon on the Frankfurt session and the New York session, which is the DAX and then the NASDAQ, the Dow and the S&P. You can also trade the FTSE in the morning as well. So this EA and this strategy was developed to take advantage of that fast movement you get at the open and hopefully make some quick money at the open. The opening range breakout EA, basically the way this one works, and there's a video all about this strategy, which I'll put a link to in the screen here now. But basically what this strategy does is it will attempt to make quick money at the open. If it fails and gets stopped out, it will then try and re-enter the market to try and get you in on the next break, because we don't know which way the break's going to go each day. So the advantage of this strategy is when you get a quick break, you make quick money and then you can stop. The problem with the strategy is on a rotation day or a range day, you can get into quite a lot of trades which don't work out as the market moves up and down and chops. So the idea behind the hedging strategy at the open was to stop you taking so many trades in rotation days and just take one trade and hope to make an exit on that trade. So what we're going to do is we're going to go through that strategy in more detail. That's the background to how the stock index hedge strategy was born and how I started to develop the stock index hedge EA to test different ways to trade at the open. So let's have a look at the strategy in action. So this is the stock index hedge EA, and basically I'm going to use it to demonstrate how the strategy works. So there's two main parts to the opening range breakout strategy, or the open of the stock markets every day. You have the pre-market range, which is what's formed before the open of the stock index. And then you have the initial candle which opens, which is known as the opening range candle or the opening range break. So this is the first 5-minute candle that happens after the opening bell on the stock exchange, whether that be the DAX, the FTSE, the NASDAQ, the Dow, whatever you're going to trade. So there is an open to the stock markets every single day. That's either 8 o'clock in the morning in the UK for Frankfurt, which is for the FTSE and for the DAX, or 2:30 at the moment, depending on whether we're on British summertime or not, for the US indices, which is the NASDAQ, the S&P and the Dow. So this initial break happens basically. And what you can do is you can take a break of the pre-market range, and then you can also take a break of that 5-minute opening range. So the difference between the opening range breakout strategy and the stock index hedge strategy is this version of the strategy doesn't use a stop loss. So instead of the market breaking long and then not hitting target and reversing the other way and stopping you out, what this one will do is it will just enter trades in the opposite direction to hedge the position. What this does is it locks in a loss. In this case, it's a profit this morning, but it would lock in a loss for you, meaning that you can give the market time to play out during the day. Okay, so the idea being is we take a pre-market range or a post-market break. So there's two different strategies here. The first pre-market range, what we're going to do is we're going to look at a range that is suitable for trading. So what you should be doing here is looking for a range that isn't too big and isn't too small. So kind of like a Goldilocks range. The statistics and the testing that I've done have shown that somewhere between 10 to 20% of ADR are the optimal ranges to take for a pre-market break. Reason for this being is that first 10% range of the average daily range of the instrument means that on a day where we open very whippy like this, you won't get taken into a trade on a tiny little range and instantly hedged. So what we want to do is we want to find a range which isn't too small, but again, isn't too big that you won't be able to get a movement outside of that initial range. So 10 to 20% of the range is kind of what I've found is an optimal. And the reason being for that as well is we work on average daily range of the instrument, as you can see there. So the average daily range here on the DAX is 2127 at the moment. And you can see that plotted there on the chart. So there's the ADR low today. So if we use no more than 20% of the average range when we take a break, what that means is we can achieve easily a 5R move in one direction or the other, which the vast majority of the time will be within the average daily range of the instrument, meaning that we can hit the target very easily. So price moves an average daily range every day, and that will vary from instrument to instrument. So if you're taking a trade, you need to make sure that the target that you set is achievable. So by using a 20% maximum of the opening range, it means that we can always usually get to target, which is 5R in this case, within the average daily range movement of that instrument. And as I said, this 10% means that we're not going to get whipsawed very much at the open. So that 10 to 20% is optimal. So what you should do for the pre-market range break is you look at the range of the 5-minute candle. And if that is within those parameters, you would take a break of that. If that is too small, look at the 10-minute range. If that is too small, look at the 15-minute range, and so on and so forth, until you find a range that is bigger than 10% or smaller than 20% of the range. Now, you can adjust these figures however you want to. These are the figures that I've settled on. And again, there's no right or wrong with anything in trading, but specifically with this strategy, I found that those are the optimal settings. However, if you take a range break, which is only 5% of the daily range, and it flies, you're going to make money, and you're probably going to make a much bigger amount of money depending on the risk that you're using. So again, there is never a right or wrong, but you need to have a setting, and this is what I've settled on as my personal preference. So that's the first break. Now, what we're going to do is, if, as in today, that initial break works, we will just take one trade, one profit, and be done for the day. That's it. The idea of this strategy is that you only get into the market once. We are either going to make money on the break, or the market is going to open with a bit of chop and we're going to get hedged, and then we're going to wait, and we'll deal with how that trade plays out in a minute. Okay, so as you can see today on the DAX, we took the pre-market 15 because that was 247 points here. 212 is the minimum, 425 is the maximum, so that fell nicely within that range. We took that break by placing a pending order above the high and below the low. So we don't know which way we're going to go at the open. So we place pending orders either side, and we take whichever way the market momentum takes us. In this case, it was long. And what I did on this particular day is I set a 2R target, which you can just about see painted on the charts here. So this is 1R, 2R, 3R, 4R, 5R, and the same upwards. So I took a 2R target, which is 2 times that range. And that is where I closed out my first position. So the best way to trade this strategy is to take 2 trades at the open. The first one is a quick scalp. So what we're hoping for is there's a large amount of volume comes in at the open, which gets us to our target very quickly, usually within 10 to 20 minutes. And then the second trade we can use as a runner to see if we get a trend day. So the market will often just move into a trend day and gradually move throughout the day or throughout the session. And our ideal here is to take one quick profit and then leave this one to run to hit a bigger target. In this case, 5R, which again is what I found is the optimal to target. We can use a trailing stop on this as well. So every time we move to one of these R levels, what we can do is we can trail our stop loss from break even up as price moves with us. So you can have a trailing stop that kicks in automatically every time we move up 1R. And that again is what I found is usually the optimal to do. So it locks in the profit. And as you can see here, unfortunately, I got taken out on a bit of a whippy candle straight after the open, but I got out of an exit there with profit. And then the trailing stop on the second position got taken out by that wick just before it pushed up. and then it pushed up into target. Okay, so that is the pre-market break. Now, if the pre-market range happens to be either too small when you've looked back through the pre-market candles or too big, we'll just skip that for the day. And what we'll do instead is trade the 5-minute opening range candle. So if that is too small or too big, we move on to trade the 5-minute opening range. The 5-minute opening range is basically that first initial balance that goes into the stock market, which is usually the banks and institutions dumping all the orders for the corporate clients at the open of the market. So what we tend to do is we get a larger than normal candle form. And again, we will measure the size of that candle. If that candle falls within the minimum and maximum, we will then decide to take a break of that candle. And as you can see here with the 5-minute break today, if you hadn't have taken that pre-market range, what you'd have done is you'd have taken a break of the high, so pending orders above there and below there, and then the market would have pushed up and hit your target on the 5-minute opening range candle as well. So that's a perfect scenario. An unperfect scenario would be where we take that pre-market range or that 5-minute range, whichever we decide to take, and what the market does is it pushes to the upside, doesn't get to our target, and instead turns around and dives back in the opposite direction, in which case we would trigger our short order, meaning that we are now hedged. So what we're doing in this case is we are now locking in the hedge. We're locking in that loss. So whatever your risk is that you set on this range, that will be the maximum that you can lose while you're hedged. So as you go short with the same amount of lots as you go long, what you're going to do is you're going to lock in a loss into your account. Now that won't change. It doesn't matter how far up that price goes or how far down that price goes. That loss is locked in because you've got the equal amount of risk to the upside as you have to the downside. So what it means is we can now wait for the market to make up its mind and decide where it wants to go today. And typically what the market will do is it will range around for a little bit and then it will take off in one direction or the other. So when the market takes off, we then will wait for the market to get to a level that looks good for us to exit. Automatically, if you're using the stock index Hedge EA, which I am in this case, it will adjust my targets from 2R immediately up to 5R. And what it will do is it will exit both positions if we're hedged when we get to that 5R target. And then you have options. You can either wait for the market to pull back and then get out of your short positions, which means that you will make that profit there and there and come out with a positive for the day. Or you can take a second entry when you get up to your target and get an aggressive entry short, which means that you've got a short position on there and you're taking a second short there, which brings the average of your positions up to the middle of the move for the day. Then you're going to find that you can get out much quicker on that exit. Third option you have is to just wait. So we get out of our longs at 5R, we have our shorts left on, and we just wait for the market to finish moving around for the day, and it will either close in a profit, in a loss, or in a loss somewhere up there. We don't know. So there's multiple ways to exit after the hedge has played out. The statistics show, after the testing that I've done, which is over around about a decade, just over a decade actually, that on average, it's very even the amount of days we get clean breaks and we get hedge exits. So on average, the market 35% of the time will break cleanly out of either the pre-market level or the 5-minute level, giving you an instant profit. So 1 in 3 days roughly will just happen and it will work and you'll get a very nice profit for the day or for the session. When we get hedged, the market then around about a third of the time will hit that second target, that 5R target. Basically, it's aiming for the average daily range of the instrument. So what will happen is it won't know which way it's going at the open, but it will make its mind up and eventually move to roughly the average daily range of the instrument. When it gets there, it tends to find exhaustion and then starts to pull back. So what we do on those cases is, well, obviously we take a long, we take a short, we exit our long when we get to 5R, which is roughly around where average daily range of the instrument would be. And then we exit after that pullback, which gives us an opportunity to exit the position in a profit, because the profit we've made there, for example, let's say that was 5,000 on that long. By the time the pullbacks got down to here, the loss on our short will be less than 5,000, giving us a positive outcome. So we'll watch this in testing in a minute and we'll see how that works. The rest of the time, so with roughly a third of the time we're going to break long, a third of the time we're going to get out of our hedges. The other times you're going to take a loss on the positions. So that loss is always going to be limited to whatever risk you have put on the size of that hedge. And you can limit this to whatever percentage you want to be of your account. So for example, if you set your risk to 1%, for example, with the stock index Hedge EA, it will automatically calculate the lot size so that this equals 1% of your account, which means that every time we break long and we get to 2R, you are instantly making twice as much as you would ever lose on a hedge. As the market around about a third of the time or over a third of the time does this and breaks, that gives us an instant edge because we're making profit on a third of our positions. The ones that we don't make a profit on that get hedged, a third of those move to target and then pull back so that we can exit those with a profit. The only ones we ever lose on are the ones that hedge and don't achieve an exit at the 5R or wherever we have set the second exit on our position. Okay, so that gives us an edge of roughly 66% on the entire strategy, okay, which is where the long-term edge in the strategy comes in. So that's basically explaining how the strategy works. So I'm going to go through now the settings for the stock index Hedge EA so we can cover every single setting, and then we'll also look at some back testing so that we can see the stock index hedge playing out and we can see the edge playing out over time. You can see what happens in different circumstances once the strategy gets into a hedge scenario. Okay, so let's take a look at the settings for the EA. I'm going to go through everything basically and just explain all the settings, how they all work, what they're all there for in detail basically. But obviously just a caveat on these, there are a number of settings in here that you will need to set up just once. And there's a number of these settings which you can adjust, which will make a big difference to the results that you achieve. However, the back testing that I've done system parameter permutations on ranges, targets, trailing stops, and the vast majority of them all come out as profitable. So there's an overwhelming number of settings that you really, it doesn't matter which you change, the outcome is always profitable long term. So more than 75% of the system parameter permutation tests that I've done have come out as a positive result. Normally, I'm looking for somewhere in the region of 60 in a strategy to be able to give you confidence that that long-term edge is going to play out in the future. And this one was well over the 75% mark. So it's actually a very robust strategy. But we'll go through all the settings. I'll explain what they are, and we'll have a look at some back tests running, as I said, in a bit. But I would encourage you to go and play around with it in the back tester. Change the settings, see what impact they have, and see how it plays out. Some people will like to have runners without stops. Some people want to have tight stops so that they make more money more often. Entirely down to you. So starting at the top, we have risk. Okay, so in here we will set how we're going to manage the risk on our account. Personally, I prefer to use a fixed risk, and you can determine the lot size for the risk basically by just running the EA in the strategy tester. So start off with maybe 10 lots and let the EA run for a few days, see how much profit and how much loss the EA makes on a daily basis. And then you can adjust that up and down according to your individual risk parameters. The advantage of using this particular parameter and why I prefer it is that the market can move incredibly fast at the open. Placing a fixed lot into the market using an EA is faster than having to do a lot size calculation using a stop loss, which is what percent of equity does. Okay, so that's the reason I prefer to use this. Market execution is just quicker. You will get a slightly different risk every day. So for example, with the lot size I'm using here, Some days on the DAX I'll experience, if we get hedges, somewhere in the region of $1,200 to $1,300. Sometimes I may have hedges which are somewhere in the region of $1,800 to $2,000. And the reason that is different is because obviously the size of the range will differ every day. For example, here we're saying that today's range was 247 on the pre-market. I've said I want a range of that to that. So if I get a range of that and that each day using the same lot size, the risk is obviously higher if the range is larger. So set a fixed lot and understand that every day you're going to get a slightly different risk on the range that is formed, but it's never going to be more than the maximum, which would be that. So do a little bit of back testing. The other option you've got is percent of equity. And as you can see here, it's 0 to disable. So I have this one set as 0 and 17 set as my fixed lots that I'm going to use. But this will risk a percentage of your equity based on the range. So if the range is X, for example, 247 in this case, what it will do is basically calculate a 1% risk. So if you put 1 in there, it will calculate 1% of your equity of your account, and it will calculate the lot size to risk exactly 1% on that range. Meaning that if we hit 2R, we make 1%, 2%. But as we're taking 2 positions, that would be a 4% profit there if you close both the positions. Okay, so that's what the risk settings do. Trade if today's close profit is below this amount is set to 1. I would encourage you to leave this as 1. And basically what this is doing is it's giving you an option to only trade if you are below a certain amount of profit. So this is something while I was developing the EA, somebody asked me for. It was made sense at the time to enter it in there. However, I'm not actually using it in any way, shape or form. But what it means is if you've been trading on an instrument already during the day and you have already banked a profit, it will only start to trade if the profit is below a certain amount. So for example, I say I want to make X amount per day. When the EA comes to look at the market, if there's already a closed amount on the account, it will basically decide whether to or whether to not to trade. But just leave it set as 1. If you're not going to be doing any manual trading at all, just leave that set to 1. And that's what the EA is designed to do, is just get you into 1 trade a day. So you shouldn't really need to use that setting. Actually, one I was going to take out, but I have left it in there because somebody asked for it. But anyway, moving on. Multiplier of range size for trailing stop. Okay, so this is to do with the trailing stops on the account. So if I just move this over slightly, this relates to these numbers you can see drawn on the screen. So that is your 5R, your 4R, your 3R, your 2R, your 1R, and that is our opening range. Okay, so what this means is this will trail our stop loss when we have closed out our first position. Okay, so the EA automatically takes 2 trades long and 2 trades short when it triggers. Okay, what you have is a TP here for the first position and a TP for the second position. These trailing stops only kick in when that TP1 is reached. The reason for that is we do not want to stop out on our positions. We want to hedge our positions. Okay, the idea is we either get the clean break, we make money, or we get hedged and we deal with it later, right? So when we hit our TP, what the EA does is it automatically break evens the second position. And then it will look at these settings here and decide how to trail the stop. So the first one there is the multiple of range to use for the trailing stop. So this is the range. Yeah, that is the range 1R. That is the range 2R. That is the range 3R. Okay, so there's your trailing stops. So if you set that to 1, it will use 1 times that range. Yeah, so as soon as you hit 2R, the EA will automatically move your stop loss up to that level because you've said, I want to trail 1 range behind where price is. As we hit 2R, it automatically locks in another 1 hour of profit for you. Okay, but it won't do that until it hits the second multiplier of range, which is when it starts to trail. So if you set this to 2 and you have a 200% of the range as a target, which is there, okay, what it'll do in this particular case, which again is what I like to use, what I found as optimal, is as soon as you hit that target, it will automatically lock in that second one because you've moved, price has moved 200% of the range or 2 times the range. So it immediately starts to trail. If you were to set that to 4, for example, what it would do is it would automatically close out the first position. It would move your stop to break even, but it wouldn't start trailing until price got to this level, which is 4R. Then it would lock in 1R of profit. Yeah, so as soon as we hit this price level, the stop loss would jump up to there, locking in 1R. If you set this number here to a 2, it would put the stop loss there. Yeah, so basically what we're saying is as soon as you have hit this R level or this R number, 2, for example, lock in 1R. Yeah, so there's your trading stops. Targets, pretty obvious. This is a multiplier, a percentage of the range. So I've got it set here to 200. So there is your range. Your first target will be set to 200% of that range. So there is the range. That's 100% of the range. That's 200% of the range. So these are going to equate to the 1R and 2R numbers. It's just displayed in a slightly different manner. Again, optimal. There is no real optimal because every day is going to be slightly different. But as you can see on this particular day, the 2R was hit very easily within 10 minutes. And then we pushed up just shy of 5R, pulled back a little bit. Then we hit our 5R target. Yeah. So 5R will typically be within the average daily range of the instrument because you're setting, if you're setting your maximum range to be 20% of the range. 20% times 5 is 100%, which will get you to your ADR figure. Okay, so those are the settings which I found work the best most often. But again, you can adjust these to be more or less aggressive depending on how you want to trade. The trading times. So this is what you need to do as your initial setup. Okay, so there's multiple times to enter here. This is very simple, very self-explanatory, really. But the first candle your broker uses on a new day. So that is going to be this candle here. So you can see this is the day separator. Yeah. And this is the first candle of the day. So if I look at my time down the bottom there, you'll see it says, you probably can't read it, but right down the bottom here, yeah, where the time is displayed, it says 9:05. Yeah. So that is that entry there. So it's the first candle that appears on your chart every day on the instrument that you're looking at. And every instrument is going to be slightly different. Different brokers will have different starting times where they open the market for you to trade, and different instruments will also have different times. So you just need to check out each instrument and individually set this up. So the first candle of the day is there. The only reason this is used is this is where it draws your range, your pre-market lines from. So you see this pre-market high line, this pre-market low line, and this ADR line here. Those start at that candle. If you set this first candle of the day to be here, that's where those lines will draw from. So that is basically what that input is used for. The last candle your broker uses each day, fairly self-explanatory, it's the opposite. So the last candle is this one here, which closes at the very end of the session. So this is the day, and that is obviously the last candle of the previous day. So if you just put your cursor up and hover over that line, another thing you can do as a little hint is if you get the vertical line tool and draw it on that candle, it will display down there that candle time. And as you can see in this case, it's 22:50. So 22:50 is my last candle of the day on this particular broker, and that is what is entered there. Again, the lines will be drawn to that line there, or that time there. And also this is used for the screenshot feature, which you'll find further down in the settings, which I can't actually find at the moment, but it's down there somewhere. There it is, screenshot at last candle of the day. Yeah. So if you've got that set to true at 10:50, in this case, the last candle of the day, it will automatically take a screenshot of the chart that it sees on the screen and save that into a file for you so that you can basically go back in time and look historically through all of the previous trades that you've taken and all of the previous breakouts. While we're talking about this, This is a very handy feature for visual backtesting. So if you run this EA in the strategy tester in visual mode and you just set it to full speed and open up the chart so that it is a nice decent size, what it will do is it will take a screenshot of every single day of testing that you do. So you can build up a history over time of every single break that you see on the instrument. So if I quickly open up my folder here with the screenshots in, I'll quickly show you that. Okay, so I've got a folder here, which as you can see has got every single screenshot in there of the DAX. So this is going back years and years and years. And this is just done via the strategy tester. So if I open one of these up, there we go. You can see that this is, you probably can't see because it's off the screen, but this is the 12th of May. And that's what happened on the 12th of May. Go through to the next, 13th of May, 16th of May, 17th, 18th. So you can have a screenshot and you can see exactly how the market broke every day. Very handy feature if you're looking to trade big news events like your non-farm payrolls, like interest rates, inflation, etc. All the big news events. How did they affect the instrument you're trading in the past? So you can have a folder and you can quickly go and look up the dates of the previous news events and whiz through to those dates and see what happened on those days. Gives you a little bit of an idea of what might happen on this news event that's coming up. Okay, so that's your last candle. Pre-market candle close time. This is 5 minutes. So this EA runs on the 5-minute chart. So this is going to be the candle before the open of the market. Okay, so in the UK, on my particular broker, the market open time on my broker's chart is 10 a.m. Okay, so it's 8 a.m. UK time. So if you hover over that line there, you'll see that on the bottom of the chart, you probably can't see it, it's small, but it says 10 o'clock. The close before the open is 9:55. So the reason these two inputs are in here is for mathematical calculations. Okay, and then you've also got the initial range after the open to trade. So these will always be 5 minutes apart. This is when the market opens. This is the 5-minute candle before, and this is the 5-minute after. This draws in these lines and also determines where we calculate our pre-market ranges from and when we take our post-market opening range breaks. All right. So that's why those three inputs are in there. They're very important and they do obviously change by broker. The fact that they're going to be 5 minutes either side isn't going to change, but the actual time might be different on your broker. Most brokers these days use UTC +2, which is what my broker here is using, which is RoboForex. So 8 o'clock in the morning UK is 10 o'clock broker chart time. Your broker may be different, so you'll need to check that out. A very easy way to find the open on your broker is, if I just remove this line, actually I'll leave that line there for a minute, is if you go on right click on your chart and go down to properties, you can show the volumes by clicking show volumes in the common tab for the instrument you're looking at. When you click OK, that will put volumes on the chart. Okay, now you can see very, very clearly, this is the pre-market volume. Let me just move my head out of the way 1 second. This is the pre-market volume. Okay, this is the market open, and there's the volume after the market opened. Okay, so there's a very clear step up in volume at the opening bell. This is the same on every instrument. So if you're ever concerned about where is the open on my chart, if you just go back to any day, it will become very, very clear where the open is. So this is back the previous day. Yeah, there's the volume and there's the massive spike up. Okay, so it's always at the same time every day, obviously, but that's how you can find the open on your particular chart or your particular broker. Okay, so very easy way to find that time. Okay, so that's the initial range after the open to trade, market time on your broker's chart, and the pre-market candle close time. Stop trading time. Because this is the DAX, I have this set to 4:25, which is basically 2:25 UK time. So this is again broker time. And that is basically when the New York bell goes. So what I am doing is for the DAX, when I take a break, if I am hedged, I will automatically close the trades at the 5-minute candle before New York opens. Reason being is I have found that a lot of the time when you get a decent break, the New York session will quite often reverse that move. Sometimes it will keep going the same way, but quite often it will reverse it as well. So what I'm saying is if there's a hedge on, I want you to close that hedge out in a loss at that time or in a profit. And again, we'll cover the different ways to exit hedges. There are ways you can exit the hedges at a particular time, regardless of whether it's a profit or a loss. We'll cover that in a minute. The second open line for extra market open, as it says there, is basically if you have another open coming later on in the day. For example, if you're trading the FTSE and the DAX, you can get it to paint in the open of the New York stock market. Idea behind this is you get another line drawn on your chart. So when you're taking those screenshots, you can clearly see where the DAX opened and where the New York opened and see what impact the New York market had on the DAX index. If you don't want to use it, that's no problem. You can just set that to the same time as the market open on your broker's chart. And that basically it will draw two lines on top of each other and you will only see one. Okay, so there's your stop trading time. Now that is a very important input because underneath here we have close all trades at stop trading time. Now basically what this does is if it's set to true, it will automatically close your positions regardless of whether they're profit, loss, hedged or whatever at that time. So say for example, we get a nice clean break like we do today. It pushes up and then we just hover around here. It doesn't quite hit our target, which may be up there, for example. What happens is just before the New York open, it will just shut your position. Yeah, and it will bank whatever you've got. That may be a profit, it may be a loss, it may be a hedge, it may be one position, we don't know. It'll just close everything out. So we're clearing the decks, getting ready to trade the next session. Okay, if you set that to false, it will only exit if it hits a take profit. Okay, so again, if we basically sit here all day and go sideways and you don't have that set to true, it will just carry on throughout the New York session if you're trading the DAX, for example, and then it will carry over into tomorrow. If it hasn't hit that target or that or hedged itself, it will just sit there. So not something I would advise. Again, I have tested this, and for the DAX specifically, it's more profitable to just close this position out before the New York market opens, because quite often you will just get a move in the opposite direction and you just sit there for the entire day and there's not really any impact on the position. So it's preferential to leave that set to true, which is what it comes as default. These next two inputs here, pretty self-explanatory. Take the pre-market range break or take the post-market range break. Okay, so we've already covered this, but the pre-market range break is before the open, is there, and the post-market range break is that first 5-minute candle. So if you don't want to take the pre-markets, you just want to take that 5-minute open, you can set the first one to false and the second one to true. Likewise, if you don't want to take the post-market and you only want to take the pre-market, you can set the second one to false and the first one to true, and it will just basically take the pre-market break for you. Okay, so you can take whichever you want to. The logic for the EA works in this way. What it will do, and this is the next area here, look, maximum bars to look back for pre-market range. What the EA does is when we get to this time here, this 9:55 candle, this is the last candle before the market opens. So as soon as we get to market open, it quickly analyzes the pre-market ranges and it will look for a range within the parameters you have set. So your minimum range, 10% of the average daily range, your maximum range, in this case, 20% of the average daily range. It will look back in time and find a range that fits those criteria. So this maximum bars to look back for pre-market range is set at the moment to 6. What that means is as we get to 10 o'clock on the chart or 8 o'clock UK time, it will look at this first 5-minute candle. Yeah. And it will say, is that first 5-minute candle bigger than, in this case, 212 and smaller than 425? If yes, we'll take a break of it. If no, we will go back and look at the next candle. So is the high of this 5-minute candle and the low of that 5-minute candle, that 10-minute range, is that within the right criteria for us to take a break? If yes, we'll take it. If no, we won't. Then we'll step back again. Candle 1, candle 2, candle 3. In this case, it found that the candle 3 range, the 15-minute pre-market range, was 247. That's higher than the minimum, lower than the maximum. So it said, this is the range we're going to trade today, pre-market. If that had been too small or too big, it would have then gone back and looked at candle 4, candle 5, and candle 6, because we have this maximum bars to look back, the pre-market range set to 6. 1, 2, 3, 4, 5, 6. If it analyzed that range and found that that was either too big or too small to trade, it would go, not taking any trades pre-market today. We'll just wait, and it will move on to trade the 5-minute range if you have that set to true, of course. So it's intelligent enough to know that when it's looking for a breakout, it should only take a break if this range is not too small that you're going to get whipsawed immediately, but also not too big that we've had too much pre-market movement and our 1R target is going to be too far away for us to achieve, or a 2R target, which is what you should be using as a minimum. So that's why that calculation is there, and that's how the logic works. The minimum range size and maximum range size is defaulted to 10 and 20%. As I said, 0.1 is 10%, 0.2 is 20%, etc. That's just what I have found have been optimal, but you can set it to different settings if you want. And again, encourage you to test. Next, moving on to drawing. Again, pretty self-explanatory, this section here. So with the drawings, basically delete the objects on the chart when the EA is removed. If it's set to true, all these lines and everything, excuse me, that it's drawn will just be deleted. They'll go. Yeah, everything will disappear off the chart. If you set that to false, it will leave all the drawings on the chart if you want to. It's entirely up to you. Horizontal lines for the risk reward levels. If set to true, that draws these horizontal lines at 1R, 2R, 3R, 4R, etc. Okay, so that just draws those lines on there. You can choose to have that turned on or off. Depends how clean you want your charts to be. Yesterday's high and low will automatically be drawn in for you. And again, we'll look at this in a minute when we're talking about getting out of hedges. But those are the lines you'll see here on the chart. So that is yesterday's low, that line there. And then yesterday's high is there. Okay, so that's that level there, which is yesterday's high. So those lines will be drawn on your chart as well. These are useful for getting out of hedges, and we'll look at that in a little bit more detail in a minute. Vertical lines at the open. This draws these vertical lines here. So that will draw an open line at your market open, and also the second open line if you've got two, so i.e. DAX in the morning at Frankfurt and New York in the afternoon, that will just draw those lines on for you. And then we have horizontal lines at ADR high and ADR low, and then we've got the pre-market high and the pre-market low. So on the chart here you can see we've got those lines drawn on. So the pre-market, let's have a look at the S&P 500 for today. So the pre-market high you can see is here, and the pre-market low is here. Now this is the range so far for the S&P 500. The S&P 500 doesn't open for another 3 hours. So what we're doing here is we're drawing a line at the highest point of the day so far and the lowest point of the day so far. When this market opens, so let's say, for example, we're sitting down here somewhere just as the market's about to open. Because these are the high and low points of the day, you will quite often find after the market has opened, there will be resistance and support at those levels, because there will be orders placed at those levels. So when you find the market pushes from an opening range break in one direction, you will often get some kind of reaction at these pre-market levels. They may hold and provide resistance and support and bounce away from them. They may have a temporary stall at those levels and then break through. You don't know. But that's why those levels are on the chart, so that we can see basically where those lines are. With the DAX, depending on your broker, you will either have very little pre-market information, as you do with RoboForex. They only show you 1 hour before the market opens. Others will show you more broker data before the open, in which case your pre-market levels might be at different price points. But That's basically what those lines do. The ADR low and the ADR high are also drawn on your chart for you. So this is the average daily range of the instrument. So all instruments have an average daily range. This is calculated from the average daily range of the last 10 days. So what we're doing is we're looking at the last 2 weeks worth of daily price movement on the instrument, and we're plotting on average how far up and how far down it goes. Okay, so the ADR low is plotted from the high point of the day. The ADR high is plotted from the low point of the day. So you can see here ADR is 2127. So if I use my measuring tool and go to the very low of the day today and measure up there, you will find that is 2133, but 2127 basically is the ADR high. And from the high of the day down to the ADR low, again, you'll find is 2127. So what it's doing is it's showing you where we would expect on a normal day the market, if it achieves these levels, to start to get tired, because on average it doesn't go beyond this. It stays here or it reverses from it. So these are important key levels. So when we are watching the market and we've got hedged, for example, we want to look for some point that we think the market may reverse from so that we can get out of our hedge position and exit our longs. So you may want to decide, actually, if we get up to ADR, I'm going to close out the long positions manually and then wait for the market to pull back and then close out my short positions, giving me a profit for the day. So that's the whole reason all of these optional lines are drawn on your chart, so that you can see previous daily support and resistance levels where we stopped pre-market and where the average is that we tend to stop with the instrument. Okay. So that's basically what the drawing tools are. They just plot lines on your chart, which will become useful for you when you're in hedge positions. The idea of the whole strategy, of course, is that we just take a break and we get there and we're done. If we get hedged, though, we need to look at where we're potentially going to exit our hedges. The shift label forward number of candles, basically, this is the hard right edge candle. This is how many candles forward we shift these price labels. So that's all that's saying is shift the labels forward 3 candles. If you want to get rid of the labels completely, shift them forward something like 30 and they'll disappear off the right edge of the chart. Vertical line after the open. So there is a number of people, and this is actually a very good strategy. There's a number of people that look at the initial open of a market being exhausted after 1.5 hours. So the idea behind this theory is that when you get an open, you get what's called an initial cash balance, and that's what we're trading. We're trading that big volatility that comes right at the open of the market, and it tends to last usually for somewhere around about half an hour to 1.5 hours. When you get to that 1.5 hour point, it's usually determined that you've probably found the high or the low of the day, because the market tends to start to lose a little bit of power. So what this allows you to do is to plot a second line on the chart, and you can set how many hours and minutes after the open you want that line to be plotted. So I've got it set to 1.5 hours. Okay, so this basically is the open, and this secondary line that you see here is 1.5 hours into the market. And as you can see, we rallied up hard, pulled back, pushed up, and now we're just sitting around. Yeah, so that is basically another time of day that you can use to potentially find exhaustion. So after 1.5 hours, there's a good chance we might actually just start maybe a little bit of a pullback, or we might start to wane and not go much further. So if that coincides with a decent level on your chart, like a daily, a pre-market, or an ADR level, that might be a good spot to start taking that position off. So that's all that one does. And we've covered screenshot at the last candle of the day there as an input. So that is basically taking screenshots. Your screenshots will be stored in your folder on MT4. So if you go up to File and Open Data Folder, yeah, click that. That will open the data folder. There we go. And you will find the files basically in one of 2 places. So if you are on a live chart, it will be in the MQL4 files folder, and you will have a folder in here which will be called stock index SIM or stock index Hedge EA, and the screenshots will be stored in there. If it is in the strategy tester, it will be in your tester folder, files, and this is an old development version of the EA, but it was a folder called Index Scalper, and in there you'll have your screenshots. You can open up those screenshots and you'll see basically the different screenshots that have been taken. Okay, so that's the screenshot setting. So now we're moving on to the hedge recovery settings. In fact, what I'm going to do is I'm going to quickly skip forward to miscellaneous settings, and then I'm going to come back to hedge recovery because this is an important part of the EA settings. So the miscellaneous, very straightforward. Offset distance for pending orders and break even, that is set to 30. So this is the distance that the EA will automatically offset for you. Let me move that over there. So as you can see here, this little red arrow, let me see if I can zoom in actually so it's a little bit easier to see. Okay. So this little red arrow here is where the pending short orders were placed, and this little blue arrow here is where the pending long orders were placed. I got a little bit of slippage today, and it's actually positive slippage for once, which is unusual. But as you can see, these are offset from the range that we are trading. And if you measure that little range there, you'll find that is 30, and it's measured in pipettes. So if you get your measuring tool and go from that arrow up to the line, you'll see it's roughly 30. Yeah, so that's the input there, which is 30. If you're on a 2-digit broker or a 3-digit broker, so these are brokers like mine is a 1-digit broker. So after the price, I have 1 digit. Some brokers will have 2 digits, 3 digits, 4 digits. They all vary quite wildly. You would just need to slightly adjust this. So it's set to 30 for me because it's 1 digit. If it was 2 digits, it would be 300. If it was a 3-digit broker, it would be 3,000. Basically, however many digits you've got after you, that's the number of zeros you want. Yeah, not the end of the world. If you just leave it as 30 and you've got a 3-digit broker, it will basically take a break immediately as it gets to that range. Show info panel true, very simple, shows that or doesn't. And this shows basically various information. It shows the ADR, the minimum maximum ranges, and the actual range size that's just been formed. It shows you your total profit today, current open profit if you've got positions open and the market is moving, and your net profit, which is a calculation between your open profit and your current profit. Sorry, your today's profit and your current profit. So if you've pushed up, closed one position, that will be in today's profit. The remaining floating P&L will show in current profit. Your net profit will be the total of the two. And then you've got something at the top called a loss recovery target. Now, this setting is covered in here, so I'm going to cover that one in a sec. The comments for orders, SIH EA. So this basically is whatever you want to appear up here. And also, it will appear as a comment in the orders. So when an order is placed, you will see that you have here SIH EA, yeah, down in the comments. So there you go. That's basically where that comment will appear. Okay, so just so that you can differentiate this strategy and this EA if you're using more than one strategy on an account. Visual mode only, set to false. It says there basically what it does. Will draw but not take trades. If you set that to true, it will basically do absolutely everything you can see on the chart here, apart from enter a pending order. Yeah, so it runs everything. It does all the calculations. It puts all the information over here. It draws all the lines. It will do everything you can see, but it literally just won't place any orders. So it disables trading. So if you wanted to use the EA as a visual tool and just look for where was the range, I'd like to take a retest of the range instead of taking the initial break. You can use this just to do visual drawing for you. And the last one down the bottom, very, very important, magic number, unique on every instrument. This has to be unique on every instrument that you place the EA on. This is what the EA uses to determine which trades it should be managing. So as you can see here, the magic number set for the DAX is 123. If I open my history and hover over these orders, you will see that it says, maybe you'll not be able to see it, it's very small, but it says placed by expert ID 123. If I scroll back and find a trade here on the S&P 500 and hover over that one, you'll see it says placed by expert ID 852. So every single instrument that you place an EA on has to have a unique magic number, so the EA knows which trades it should be managing. Yeah. So the reason for this is, as you can see, I personally trade 4 different instruments. I trade the DAX, the S&P 500 up there, the NASDAQ, and the Dow. So each of these, if I open these up, you'll see has a different magic number. That is 852. The magic number on the NASDAQ is 789. The magic number on the Dow is 456. And this one is 123. It doesn't matter what they are. They just have to be all different. So, for example, this afternoon when we're trading on the S&P, the NASDAQ, and the Dow Jones, it will take all of these trades individually, depending on what's happening with the ranges and what the settings are on them. But if it takes a break of that one, it needs to know that the stop loss settings on this one do not affect that one. So it will use the magic number to say, right, unless the order is taken with magic number 123, I'm not going to touch your trades. I won't adjust them. I won't do anything with them. Okay, so that's what the magic number's for. It's a very important point. Has to be unique. 99% of queries I get about my products are, why has it done this? And the question is always, have you got a unique magic? Oh, no, I haven't. So basically, all of the different EAs are managing all of the trades and they're fighting over what they should all do with it. So that's why you have a unique magic number. Okay, so that's all the main settings covered. The next settings we're going to cover are hedge recovery. So there are 3 ways of exiting a hedge. Okay, so when we get hedged, okay, we've gone long there and we've gone short there. There are 3 things that now we can do. Okay, what the EA will automatically do when you get hedged is it will move your TPs from the first target automatically to your second target. So in the case of the settings I'm using here, it will move my TPs from 2R to 5R. Okay, now what's going to happen is the market will now do one of 2 things. It will either hit that profit or it won't. If it doesn't, what the EA will do is it will just exit at whatever my hedge loss is locked in at. Okay, that's the first option. The second option is when we hit that target, we now can do a couple of different things. First is we can just take the profit on the long and then wait until the end of the session. So just before the New York open, we will just wait for price to drift around and close it. Okay, so that's option number 1. We just basically wait and we take whatever. So we will hope that price closes lower than the take profit we have made. That will lock in automatically a win for us for the session. If price pushes up to that level, we could also do an aggressive exit where we enter another position and then when price moves down, we exit at a profit target. Yeah. So that's an aggressive exit. The downside to that is if it pushes up against us after we've entered another position, we don't just have 2 shorts there. We have another couple of shorts there, which are also going into drawdown. So that exponentially increases the amount of loss we could potentially take. That's why it's called an aggressive exit. It's a little bit more dangerous and you can have slightly bigger losses on it. So when we're exiting, we need to decide what we're happy to get out of our hedge with. So what's built into the EA are a number of different exit strategies. So the first one we're going to look at is the conservative hedge exit with a profit target. So if you set this to false, the first scenario I said that could play out will happen. You will basically have your TPs adjusted to TP2, which in this case would be 5R. And if price hits those, it will close those out, put those in the bank. So today's profit will have whatever that is. And then it will just sit there and it will wait until 425 and it will close the rest of your trades out. Yeah. So if that is set to false, it will just sit there and it will just wait. All right. The conservative hedge exit, which is where that is set to true, what it will do is it will try to achieve a percentage of your banked profit. So say, for example, we closed out 1,776 in profit. Yeah. What the EA will do is it will look for, in this case, because I've set it to 0.3, 30% of that profit. It will look to see if we can achieve a net profit of 30% of that to exit our position. So if we look at grab our calculator, so 1776 is our profit times 30% is 532. So what the EA will do is when price hits our take profit, it will just monitor our net P&L and hoping that price will just drop enough so that it can get us to 532 in profit. Yep. And if you think about it, it hasn't got to actually do an awful lot to get there. So let's look at what we have got as loss on our account. That is our risk. Yep. So that risk is 247 points in this case. Price pushes up, hits our target, we exit those longs and we make money in our bank account. Okay. If price pulls back down by 247 points, what that does is it gives us a net profit of 0. Yep. So we've banked that, and the drawdown that we have on this short position is basically whatever we've banked plus that amount, 247 points in this case. So all you need is for price to push down that far and you could exit with a completely break-even position. If you set that to 0.3, and as I said, we're looking for around about $500 in profit, it would need to push down a little bit further so that the difference between what you've banked and the difference between your drawdown is $500 in profit. When it gets to that amount, it will exit for you. That is your loss recovery target. Remember, we covered that earlier when we were looking at the info panel. You will see that up there appears a loss recovery target. So if I just try and quickly find a screenshot to demonstrate that. Oh, there we go. Perfect. So you can see here that we basically will have banked on the short move here, probably somewhere in the region of 7,000. What it's done is it said our loss recovery target to get out will be 3,235 in this case. So what it's saying is, right, we've banked about 7 grand. If it pushes back far enough that we can get a profit of 3,235, close the whole thing out. In this particular instance, what it did was it just went completely sideways for the entire session and went, no, sorry, couldn't hit your target. So I'm going to close you out with whatever I've got locked in as a loss. Yeah. So that's how that works. And basically you can set an amount in the EA that you want to achieve. So if you were to set this at 0.01, for example, what that will do is it will get you out with a break even. So price pushes up, hits our 5R target. As soon as it's pulled back by 247, that will get to pretty much 0 and it will just go, we're out. Okay. So the days where you don't get a clean break, you can set the EA up to basically get you out with a break even on those days, meaning that you don't lose any money. So rather than taking a loss when we don't get those nice clean break days, remember around about 30% of the time the market will break, hedge, and then move to the second profit target. On those days, we can try and exit those with no loss, which means you're instantly got an edge, which plays out long term to make you profit. Okay, so that's the first version, and that is basically setting conservative exit to true and saying, get me a loss recovery target, which is a percentage of whatever we've banked on the trades that have hit target, and try and exit me. The second or the next version of the exit, if you like, is going to be the aggressive hedge exit on profit close. So what this does is when you hit that profit target, that 5R profit target, when you're hedged, you will have a short position on. What this setting will do is it will also try to achieve that loss recovery target for you, but by taking an additional trade. And the way it does that is it waits for your profit target to be hit, and then it will automatically place a pending order under the low of the candle that hits your profit target. So what we are doing is we are waiting for price to stop pushing against our hedge position and to come back down in our favor, i.e. trigger a new short order, which brings our average price up, which means we've got twice as much short exposure, which means the exit is twice as fast. So it's an aggressive way of getting out. It works very, very, very well when the market is moving with market structure. When the market is ranging, it's less effective. So what that will do is if the market continues to push in your direction after you've exited, it will put a pending order in the market. If it hasn't triggered, it will cancel that pending and replace it under the low of the next candle, and so on. If the market keeps pushing against you, it will keep trailing that pending order higher and higher. You can see that on this screenshot here. So we hit target there. It placed a pending order there and continued to push down. So as the price pushed down further, it placed another pending order. It pushed down further, it placed another pending order. It pushed down further, it placed another pending order. But then the market went sideways and triggered our entry. So instead of immediately getting into the market, we wait for signs of strength back in our direction, hoping that that will be enough to exit our position. Now that move there, from there to there, was possibly enough to get us to a break even. However, on this particular instance, I would imagine the EA was set to somewhere like a third or half of the position that we've already closed out to try and recover that, in which case it didn't close the position out. So as you can see, that setting for closing out or setting a loss recovery target at a percentage of our closed position is quite important, and it will vary. So that's basically how the hedge recovery system works. There's 3 different options. Yeah. So the first one, just to recap, you would have that set to false and that set to false. So all that will do is, if you get hedged, move your targets up to wherever your second target is, 5R in this case. And then after it's closed, it just sits there and waits and closes it out at the time you tell it to close. So that is the standard exit. Hopefully we push up, hit target, and whenever we get to closing, it's lower and we bank a profit. Yeah, happens a lot. Second is the conservative exit, where we basically look to try and get out with an amount of money. Yeah, so we have a loss recovery target we set. So we're saying, I know it didn't work out today, but if you can try and get me out with a small amount of profit, fantastic. So that might be a few hundred. So if you're targeting, like I am, $1,000 to $3,000 or more profit a day, I might say just try and get me out with $500, which is achievable. And that is your conservative hedge exit. Your final one is the aggressive hedge exit, where we get in with another position and we try and make sure that we get out quick on that pullback. So if that was to push and pull back, that would be enough to exit if we're being aggressive. However, the danger of that is if it pushes against you, which it looks like it might be doing today if you had have hedged, it's gradually grinding up. So let's say, for example, there's our target. We'd hit that target today. We would have a pending order placed under that candle, which would have triggered. We've gone short there. We've gone short there. So our average is going to be here. So we would only need really to get down to somewhere like that to get out with our loss recovery target. But unfortunately, it hasn't happened. So we're not only going into drawdown on that position, which is more than our take profit was, we're also now going into drawdown on that position as well. So we're making more loss than we would have if we'd have stayed in the hedge. That's why it's aggressive. You get the choice. It's up to you how you want to exit. Test them all, look at them all, and see what the pitfalls of them all are. You've got that screenshot facility in the EA. That's going to help you understand what happens in different market conditions. Nice clean break, 3,000, done. Yeah, didn't take any trades that day. This one was a hedge. Yeah, so we hedged long, we hedged short. There was nothing we could do. The market just did not move all day, and we closed out with a loss. There was no way to make money on a break today. We didn't break. Yeah, and then throughout the entire New York session, we did exactly the same thing. This one here was too big, so we didn't take a break. That one was another hedge exit. We couldn't get far enough. Why? Because the range was too big. This is, by the way, these screenshots are part of my testing. These are old screenshots where I was testing different pre-market ranges to see what happened. You know, some of these days where you get these big ranges, you've just not got enough momentum to go anywhere. So there's nothing you can do but take losses on them. And then we've got other ones. Let's try and find an example of a loss recovery target. There you go. So this is a loss recovery target exit. Perfect example. So we took the pre-market range. We broke long. Didn't work out. So we broke short. We moved all the way down. We hit our 4R target. We placed our pending orders when we hit our 4R target. We entered with an aggressive exit, and the loss recovery target was set to $3,000 because that would have been around about a $7,000 profit on that move. And we pushed up far enough that we could exit with $3,096. Yeah. So long entry there. Our second long entry was taken there. That was all the movement we needed. 10 minutes worth of pushing in our direction, and we got out with a very, very nice profit on the day. That would have been roughly, I think at this time I had it set to 40% of the banked profit. Yeah. Obviously, now, and this is the other thing about the aggressive exit. Yeah. So this is the aggressive exit. Now remember, if we're using the conservative exit or the aggressive exit, we're using a loss recovery target to try and get ourselves out with a small amount of money because the hedge has triggered and we haven't had a clean break. However, if we hadn't have used a conservative exit today, what would have happened? We would have gone down and we would have hit target of $7,000 roughly on that position. The market then reversed completely and closed the long in a profit. So the actual profit on this particular day, because we had a V-shaped recovery move put in during the entire session, would have been somewhere in the region of 7,500. We closed it out at 3,000 because we got out quickly with an aggressive exit. But you can see that if you'd have just left it to play out after we'd hit target, we just would have got out with a profit anyway, regardless. So the aggressive exit can get you into trouble, and some of the times you get into trouble you will just be able to get out of anyway just through normal market movement. So again, test all of these exit strategies and exit criteria, see how they play out, see which one you prefer. No trade taken there. Nice clean break to 2R. That was another hedge day. That was another hedge day. And again, if you'd have left this to play out during the New York session, you would have got a 5R target or a 4R target. An aggressive exit would have got you out. Some days it's better to close out there. Some days it's better to close out at the end of the day. There is no right or wrong. Every time I show you an example where it would have been better to leave it running through New York, I can show you an example where it wouldn't have. There's always going to be advantages and disadvantages to every day and every type of day. No day, as you can see, is ever going to be the same. This one, very nice tight break. As you can see, the range was 160. The minimum I was looking for was 144. The average daily range back then, whenever this was in 2020, was 144 points. So we broke, hit target, trailing stop took us out, and then it moved down to somewhere in the region of 10 to 12R and probably down to 15R. Days like this are very, very rare. You are going to get them, but you're not going to know they're coming, so you can't plan for them. So you can see there's many, many different types of day. Beautiful example there of a loss recovery target not working. Yeah. There's your break. We got hedged, just got hedged on that long by probably 1 or 2 pips. We broke to the downside. We got out. We put an aggressive position on, and it drove against us for the rest of the session, closing us out with a larger loss. Yeah. Loss recovery target was 3.5. If price had managed to get back up to there, that would have been an exit, but it didn't. But look at what the difference is between exiting at end of session and potentially ending at the end of New York. That would have been a much bigger loss, wouldn't it? So again, play around with these. The aggressive exit is something that gets you into more trouble. But as I said earlier, the days that you get into trouble with those tend to be news days. Okay, so if you're aware of news, there's a good chance that you will probably go, right, I'll shut this and walk away with a loss rather than take the chance on the news. Yeah. So the other thing I just wanted to cover for the stock index hedge strategy, and for obviously use of the EA, but for the strategy in general, is using support and resistance. So we are drawing onto the chart these pre-market levels, ADRs, yesterday's highs, yesterday's lows. Okay. If you join me in the live rooms, you'll see me using this strategy, and you'll see me to do this on virtually a daily basis if ever we get hedged. And that is basically manually intervening with the strategy or manually intervening with the EA. So, for example, today we've got a nice clean break. Yeah. So what I would be looking for on a nice clean break day is an exit and then walk away. Okay. On a day where you get hedged, what you're doing essentially is, rather than taking a loss, you are buying yourself time to analyze this market and look at potentially where the market is going to go. So what we're going to do is we're going to quickly look at ways to exit hedges manually once you've got into them. And the best way to hedge exit manually is basically to use support and resistance levels from the past. So looking at the DAX right now, if I scroll out, yeah, let's say, for example, we got hedged today at the open. I would be looking for price action to tell me where the market is likely to turn at some point today. And as I said before, the obvious spot is always going to be the average daily range of the instrument. So if you haven't got any news, like we haven't in this particular day that we're looking at now, there's no news scheduled for today at all. What we would tend to find is if we get to ADR, you'll probably find that the price will pull back from there anyway, because the market is exhausted and it will need to breathe. Market structure means that we push and we pull and we push and we pull and we push and we pull. So by the natural movement, if we'd have got hedged today, we would expect at some point for the market to pull back. So when the stock index Hedge EA gets you into a hedge, it will place those TPs for you automatically at your second TP level, which in this case with the settings I'm using here are 5. Now that doesn't mean I need to leave them there. Okay, so as you can see here, the 5R target to the downside was there. Okay, so let's say we got hedged today and the price started to push down. Personally, what I would be doing is I wouldn't leave that target at 5R. What I would do is move the target down to yesterday's low, because this is where we hit the bottom yesterday. We pulled back, and as we got to that level, we bought from it multiple times and pushed away. So I would expect the market participants to have limit orders sitting at this low ready to trigger as soon as we get down to there, which is what typically happens. If you look at any daily chart, you will find often intraday, you will hit the daily highs and lows of the previous day or the day before, and you will bounce from them. Now, you won't necessarily reverse from them, but you will at least bounce from them. The reason that bounce is caused is because there are limit orders placed by banks and institutions at the previous day's highs and lows to automatically re-enter into long-term positions that they have in the market. So we can use that to our advantage by identifying where those levels are and watching for price action when we get there. So let's say, for example, we are now hedged. To the downside, I would be watching yesterday's low and the previous day's low. So if we push down into this level here and we basically just stall out and then don't bounce, I would be looking to see if we push down and bounce from the next day's low. If that was to fail, I'd be watching this area down here, which is last week's low, for a bounce. So you can adjust your TPs down to these levels, or you can manually exit the trades at these levels. And then the EA will just take over and replace those pending orders if you're in aggressive mode to get you out of the trades. Or if you've got conservative mode, it will just try and wait for a pullback to exit you manually when you get to your loss recovery target. To the upside here, I would be looking at ADR high as an exhaustion point. If we got through the ADR high, I'd be watching this high here and this high here for price action. So if we got to ADR high and literally screamed through it and then sat there, I may decide if we push back down there to exit the long positions and hope that we pull back to exit the shorts, or I might set the take profits up to those levels and hope that we get a bounce from those levels, because that's where we bounced from before. There will be orders placed to bounce there again. Yep. So this is partly why we have these lines drawn on the chart, so you can identify quickly and easily areas that we've previously reached or are likely to reach where the market may exhaust. So if you have, for example, as in today, your 5R target set there, and it makes no sense for the market to churn there, but it does make sense for it to turn there or there, manually adjust the targets. Pull the targets down manually yourself and put them in the right levels, and then hope for those bounces out of those levels. And obviously then the loss recovery target or conservative exit or normal exit without a conservative exit will automatically happen for you. Okay. So if you want to come into the live rooms, you'll see me executing this on a daily basis in the live room. But those are basically the settings for the EA, and that's a pretty much complete overview of the entire edge of the stock index hedge strategy. Okay, so you can download the demo from the marketplace, from the MQL5 marketplace, and just run it in the strategy tester, have a play around with it yourself. And obviously, you can set it up to work however you want it to. But with all EAs, I would always say, and you'll hear me say this in the live room all the time, EAs are mechanical instruments. They are there to automatically execute trades and strategies for you. They do not replace you as a trader. So you still need to watch what's going on. You still need to interact if necessary. If something is obvious that it's not going to do that, it's probably going to do that, intervene. Yeah. So that's it. That's an overview of the stock index hedge strategy. That's an overview of the EA settings. We've looked at some of the back tests previously. If you've got any questions, you can come into the Telegram group. You'll have seen along the bottom of the screen here, constantly going along, are links to the website, to the Telegram group, and I live stream twice a day, every day on YouTube, so you can come and join me trading these strategies as well. Hopefully you enjoyed that. If you've got any questions, come and find me in Telegram or stick it in the comments section below. And good luck with your trading.